post-midterms, you generally get about a 10% rally in the Q4 following the midterm election. That being said, we know there's things going on with rates going up and trade concerns, so maybe that historical average isn't going to hold, but we do think in the next 12 months the market is moving higher.
Moving higher over 12 months, it feels like we're caught in this push-pull still that we've been in all year, where the good news kind of ends in higher rates, the good news ends in Fed being more active, and valuations have come in, but not necessarily cheap. So what gets us out of that, if anything, Samantha?
So I think you would just have to see sentiment change. We always come back to sentiment. Investor sentiment is just okay. People don't feel that good, even though the data is really strong. And it's interesting, if you break it down by Republican and Democrat, confidence changes even more drastically, with Republicans obviously feeling better. But putting money to work is something that clients feel nervous about, but we know this cycle has more room to run.
Jurrien, are you viewing the market through a prism of fading fundamentals, but solid seasonality and technicals like buybacks?
Yeah, so the buyback window just reopened again, and by some measures, buybacks are going to be about 800 or 900 billion this year. So it is still a very big number. It's going to add probably 3 or 4 percentage points to earnings growth. So it's certainly not something that should be underestimated. But I think, we've had this big earnings boom this year. Third quarter actually ended up, I think, surpassing everyone's expectations. At the beginning of earnings season, everyone was worried that, the jig is up, profit margins are going to erode as labor costs rise. And we're here at plus 25% year over year, with 82% of companies beating by an aggregate of about 600 basis points. So, but the market looks past that. The market doesn't reward, unsustainable big earnings spurts. So the question is, where do we settle in for 2019 and 2020? And if it's at 10% earnings growth and we have a 15, 16 multiple, and the Fed is going to end at neutral at 3%, there's not a lot not to like about the stock market, but there's a lot of variables in there, because earnings growth could surprise to the downside, the Fed could surprise to the upside, and then that's a whole different story. So we really don't know how the next chapter of this book is going to be written.
Which way does the Fed surprise when we're getting hot wholesale prices and cooler oil, as we mentioned at the top?
Yeah, I think the Fed is actually being refreshingly plain-spoken these days, and very logical about where it's going. And I think what the Fed is saying is that we're at 2%, neutral is at 3%, so we have to go at least to 3%, because we're hitting both on our full employment mandate and our inflation mandate. So there's really no justification or reason to be below neutral, which I think most people think is around 3%. And I think the Fed has pointed out that inflation can run a little hot north of its 2% target, and that's okay. But I think what the Fed is really looking at, and what I'm really looking at, is the inflation expectation. So the 5-year forward tips break even has been very steady at about 2 to 2.25. I think if that starts to get unanchored at some point, that will really influence the Fed, and that might force it to go beyond neutral to 3.5% or 4%. But at this point, there's no evidence that that's happening. But I think the inflation expectations are even more important than where the actual inflation data are running right now relative to the Fed's target.
Samantha, the rest of the world equity indexes have not gotten as much relief as the U.S. They've continued to lag. Is that just telling us a story of a soft patch in global growth? Do you think this divergence can persist with the U.S. continuing to outperform?
So obviously, if trade concerns continue, which that is still very much a wild card even after midterm elections, trade's still a worry, which means it's still a weight on international. And then obviously the strong dollar is not helping. Over the 10 years, to bring it out to a much longer time frame, we do believe in international. It's just been a very hard case to make to clients in the shorter run.
Has there been any discussion in your circles about the corporate tax rate and whether or not the president is serious about giving back some of those cuts to pay for different kinds of cuts?
So we think the one thing we know post-Tuesday is that we're not going to get a tax cut 2.0. I know that was obviously back on the radar. It's still in the realm of possibility, but we're now focusing on an infrastructure bill.
Right. And finally, Jurrien, when you hear the term fading fiscal stimulus, do you agree with it?
I mean, it's interesting you mention that, because generally the playbook, post-midterm election is that the market has its best year. That the first 2 years of a presidential cycle tend to be below average, the last 2 above average, and presumably the reason for that is that historically, administrations have sort of backloaded the economic stimulus in order to get reelected. This year, I think it's all been front-loaded, so I don't think that third-year scenario actually is going to work this time. But it wouldn't shock me if the fiscal stimulus does continue, but I certainly think fading the earnings growth from the taxes and fading the fiscal stimulus, that we're starting, 2019 will see less positive effects of that than in 2018. But that may also take the Fed out of the picture sooner, which will be a positive. So it remains very much a balance between the earnings side and the liquidity side, and that's why we've been in this holding pattern.